Hey, everybody. Good morning. We are live at Saturday morning, Multifamily Unplugged, and welcome to the show today. I am glad that you're here. Remember, if you are new to the show, go wake somebody up. Tell them that we're on the air. If you've been here before, go wake somebody up. Tell them that we're on the air. Grab your coffee, sit back, buckle up, because today is going to be a good ride. Glad that you're here today. So, I always start my show, right? I talk about intentions. What's your intentionality? What's your intentions and what are you going to go out and accomplish in your business, in your career this year, this quarter? What are your goals that you've set and how are you going to attain them? I want you to think about that. I always talk about how we need to start our day with intention, right? What are your daily disciplines? Do you get up? Do you exercise? Do you pray? Do you meditate? Do you spend time in your gratitude? What are you grateful for? So I want you to think about that. And if we start our day that way every day and we build into that every day, it's amazing what happens in our personal life and our professional life. And I always say that we don't grow professionally until we grow personally. So I'm excited about this morning. I'm excited about my guest. I'll introduce her in a minute. But I want you to know this show today is brought to you by the GOB Multifamily Network. We're having our second annual conference this year in Chicago. It'll be July 13th and 14th. It's going to be at the Westin O'Hare. If you are coming to Chicago for the event, make sure you spend a couple of extra days because Chicago this time of year is great, even as hot as it is right now. And if you are just coming in for the event, it's going to be a lot of networking. There's expected to be 500 or 600 people there. So it's going to be a great event this year. A ton of speakers. I think there's 20, 25 different speakers. And the goal of the conference is to do 40 deals in the room. So it's a big goal. I don't know that it's ever been set by any type of multifamily seminar or event that's gone on in the past. But if you have a deal, bring it to the event. If you want to be a partner or get on a team that is going to be doing a deal, come prepared to do that. You're going to have a lot of opportunity and a lot of things to learn and gain from. So even if you're somebody with no experience, this event will be great for you. If you're somebody who's seasoned, it's going to even be the biggest shot in the arm for you. So that's July 13th and 14th. If you go to the GOB network to sign up and register, use my last name and you'll receive a $100 discount on your tickets. And I look forward to seeing everybody there. Okay, let's get to today's show. I'm excited. My guest is Whitney Elkins Hutton. Whitney is the Director of Investor Education at PassiveInvesting.com. Let me bring Whitney in. Hey, good morning.
Good morning.
How's it going?
It's good. The sun's shining. It's a little windier, but that's good.
Good. Where are you calling from today?
Boulder, Colorado.
Boulder. And is it warm there?
It's a little toasty. We've been hitting 90-degree highs, which for us is a little unbearable, especially since most of the homes here don't have air conditioning. We haven't really needed it.
Are you up in the mountains or not?
No, I'm in the foothills of Boulder, Colorado.
Okay. All right, nice. Good for you. So, Whitney, one thing I always ask my guests when I start every show is, in one word, what best describes you personally and professionally?
The word that comes to mind right now, especially with things that I've been going through in my life, is resilient. I think that's a common theme that continues to come up. It's just resilience. Like, how can you continue to take incremental steps, one step at a time, moving forward, and continue to ask yourself, how can I, and not I can't.
Yeah, so that's really cool because that's my word.
Oh, no way!
Yeah, for sure. So if you read my bio,
no, just kidding.
I didn't coach her either before this at all. So everybody just know that. Hey, so if you read my bio, it says that in there. So that's pretty interesting. And is there anything there that you don't want to talk about today, or are you open to sharing?
I think I'm open to sharing. Yeah, okay, let's do it.
Yeah, and I only asked
because,
yeah, I only asked because you said, hey, because of the things going on in my life right now.
Oh, we just recently lost our dog. So 14-year-old, your BFF. So maybe let's kind of steer clear of that topic, but yeah.
All right, good. So how about a little background? Why don't we tell the listeners a little bit about you and your history and how you wound up in this crazy world of multifamily or capital raising?
Oh yeah, definitely. So I started off, well, my background, I come from public health. So I started off, Tulane School of Public Health in tropical medicine, went and worked infectious disease for the state of Louisiana. And then also with the CDC, I was doing a lot of work with the CDC whenever 9/11 happened. And I know people are like, well, how does that like actually fit into your real estate career? Well, I was working 80 hours a week. I was traveling a ton. And I was such a nut. Like I loved the movie Outbreak. That was exactly, I wanted to be like, Rene Russo and Dustin Hoffman in the movie Outbreak. And I kind of got my wish to a certain extent. And then I bought a house with a significant other. That just seemed like a logical next step in my life. And then the relationship fell apart about a month later. And then I panicked. I thought that house was going to ruin me. And so, but what that did, it sparked this real estate career that probably otherwise I never really would have gotten into. And so I had this house. It needed a full rehab, gut rehab almost. And I was footing all the bills, all the expenses. So I stuffed it full of roommates. Got the Home Depot 1, 2, 3 book because YouTube then didn't exist. Did a lot of projects on the house that I probably should not have done. Learned a lot that I don't like drywall. I can't stand it. Anyways, but about 11 months later, I sold the property for a profit. I made just as much money on the sale as I did in my day job for that year, with a lot less time involvement. I'm like, wow, my mind was blown. I'm like, my time doesn't have to be connected to trading money. It just has to be connected to creating value. And so that was a huge life lesson for me. Did a few more projects solo, met my husband, did projects with him. And then we hit another ceiling of achievement because we were like, wait a second, we just have a second job. How do we start like scaling our portfolio and actually like unlocking our golden handcuffs from our job? And that's when a friend of ours just said, well, why don't you keep the properties and rent them out? I felt like slapping myself in the middle of the forehead. I'm like, that just seems too logical. Why? But we did. So anybody that knows me, once I get an idea in my head, I dive down the rabbit hole. I'm gone. I'm 15 steps ahead of you. And so we scaled our portfolio pretty quickly in the next year and a half to 30 single family properties, still doing flipping on the side to add capital. And then we hit our next level of achievement, which was trying to get better time leverage. And so my husband wanted to join the financial independence movement along with me. And we hadn't really planned for him to do that. And I'm like, I can't do 80 single family properties. We're going to have to figure out a way to scale. So that's where we launched into doing both active multifamily on our own, but then we had so much capital that was building up on the sidelines from our single family properties. And like, how could we invest that passively? And then, fast forward, several years later, we have, multiple units under our belt and both actively and passively, and we're super excited for it.
Yeah, interesting. So a couple things I want to just unpack a little bit. First of all, you come from the public health field, right? Mm-hmm. And it's not like you have any background in finance or economics. And it just goes to show that anybody from any profession, and that's one of the things that kind of struck me, after doing so many of these podcasts is, people from all walks of life, any profession, I think it takes a little bit of desire and, the ability to jump in that rabbit hole, right? And to, just say, hey, I'm going to go do this. It's kind of what I did when I went from single family into multifamily. I said, okay, let's go figure it out and let's go do it. So I think it takes there's a certain person that has to happen for, right? In order to do that. So it's interesting. But the other thing you said is 80 single families. Holy cow. When you talk about 80 roofs and 80 furnaces and 80 driveways and,
No, thank you.
Oh my goodness. But when you condense that to the economies of scale of maybe 1 or 2 properties or, multiple properties that you have less roofs, less furnaces, less hot water heaters, it makes life so much simpler, doesn't it?
It does. It does. I mean, there's pros and cons to both strategies. However, for, what we were looking to do was, and I do this with my coaching clients all the time. Like, what is the shortest distance between 2 points. And most people will put 2 dots on a piece of paper and they draw a straight line, right? Well, actually, you got to fold the paper, right? And that's what I was looking to do. I knew where we were, point A, and where we wanted to go, point B. I needed to figure out how can we collapse time and do that so much faster. And that's really where multifamily and then eventually self-storage and, other modalities like that came into play.
Nice. Good for you. So where's your heavy concentration right now? What asset class?
Well, when you look at our portfolio, it's largely multifamily. For me, maybe this is my public health background, but, everybody's going to always need a roof over their head. Now, when you look at the economy, and that is something, when you start diving into, any of these asset classes, you start learning a little bit more about economics, how money works. Then adding in like self-storage, mobile home parks, stuff like that actually makes a lot of sense. Not only from a diversification standpoint, but also just, complementary assets within the portfolio. Also, I'm super excited, with passiveinvesting.com, we've recently brought into, and we've been working on these verticals for about 3 years now. I mean, COVID had us push pause on a couple of our verticals. We didn't launch them when we originally anticipated, but we are now doing car washes and hotels. And so I'm super excited about those asset classes because there's just an immense amount of value that we can create there.
Are you ready to skyrocket your investment portfolio and leave a legacy? Are you tired of inconsistent returns received in the stock market? Then it's time you take a look at alternative investment options like a passive investment in multifamily real estate. No tenants, trash, or toilets, just a solid return on an annual investment, including quarterly returns along the way. These lower risk and secure assets are also a great hedge against inflation. If you want to hear more about these types of opportunities, email me directly to schedule a 15-minute consultation to see if you qualify. You can email me at mike@mycoreintentions.com. So let's talk about both of those because I have a real affinity for car washes. I've always wanted to own one. Okay. So maybe I'll get a little insight and maybe a kick in the butt here, but also the hotel thing. Are you buying old hotels like the old motel type thing and converting them, or are you buying, like 60, 80 key properties and converting those?
Yeah, so our current deal is in Hilton Head, South Carolina, and it's a Holiday Inn Express, and it's 150 keys.
Okay.
And
nice.
So, keys, doors,
Yeah.
just kind of equate the, help connect the dots for listeners. But, that where we are kind of honing our space is in the limited services space. So like any sort of, you have multifamily, you have A, B, C, D class, right? It can be in a major metropolitan service area or a tertiary or, any scale in between. It can be value add, core plus, right? We have the same type of investment strategy we have to create for hotels. And for us, we are looking not at your full service, like your convention centers or wedding venues. We're not doing your budget or your micro hotels. We're in that limited service space. So it's going to be like your Marriott's, Holiday Inns. Now, those are your branded hotels. We're looking at branded and independent limited service hotels. I think what's more fascinating right now, especially when you look at COVID, is leisure hotels did extremely well, especially if you had like somewhere between like 15 to 30 million people within a 300 to 400 mile radius that could drive there. And so we're looking for leisure-driven hotels that have a strong corporate history to them. Corporate travel isn't entirely back yet, so we're seeing a lot of these hotels undervalued because of that. But when it does come back, that's going to be a huge boost to the equity for us on that property.
Yeah, that's interesting. Do you have could you predict when you're going to start to see more corporate movement, or?
We're already starting to see it.
Yeah.
So, and this also kind of lends to the areas in which we're investing as well. We see that with multifamily. Multifamily, when you're evaluating a property, you're probably also looking at the landlord tenant laws of the area, tax rates, the laws of the local jurisdiction. Same thing with hotels. We're looking at, how do the hotels operate during COVID? What are the, different laws that are in place? What happened to them during COVID? And the Southeast, there's, philosophically, they're very open right now. A lot of the United States is honestly very open right now. So.
Yeah. A lot of places are, I'm in Chicago and there's still some restrictions and some things, but for the most part, we're open, but not completely. But, it's changed a lot. I don't know that we'll ever be back to what normal was back 2 years ago, but, it's coming back. Hey, what's the difference in between a hotel and that hospitality space versus multifamily space? Is there a cap rate difference in there?
So a little bit of a cap rate difference, but I think you have to take a primary look at how the income is coming in. When you're looking at multifamily, that you can only adjust your income generally annually whenever you renew the lease. On the hotel space, we can actually do that nightly. And depending on heavy travel situations, maybe a couple different times, those rates can adjust a couple of different times during the day until somebody books. Also, like with multifamily, you're probably looking to be somewhere between 90-95% occupied. Never 100%, right? You always want to have units vacant to where that you can repair and get closer to market rent. Hotels, you're going to operate at a little bit lower vacancy than that, so you can capture that last minute traveler that's coming into town and needs a hotel room right now. So
yeah, sure. Yeah, interesting. So let's talk about car washes for a minute. Are you buying big full service deals or what type of car wash?
Yeah, we're so to kind of break it down for listeners, you have like your full service car wash, somebody comes out and washes your car end to end. You also, I don't know, we have a camper van, and so it's too big to go through any sort of car wash like that. So you have to put it in the garage, right? The coin operated car wash and get the brushes out, pray your 10-year-old doesn't spray you with the hose, right?
Right.
And then you've got the car washes that are attached to like gas stations. So a little, kind of a hybrid, self-service, getting into like more of that express service. We're operating in an express tunnel service industry. And so you've probably seen these, a lot of major metropolitan service areas have these, especially in the Southeast. And so, you can drive in, you can put your car through the tunnel. There's like pretty cool lights and stuff like that. And then it's, all automated for your car to move through the tunnel. And, it's getting washed, waxed, dried. The tires are getting treated all, in an automated fashion.
Yeah. So are those, and here's what I would ask, are those like the $3 car washes where by us, we have what's called Busy Bee, which is, probably just the name. And there's another one called a Kano Serve or something like that. But they're like $3 car washes for the basic minimum. You wind up spending 10 probably because you get a little bit more service. But is that the type of facility those are?
Well, that goes back to the business model. And so a lot of these car washes that we're purchasing are like these Busy Bees where you're paying individually per wash. Right. Now that leads into the larger business plan of growing this type of portfolio. We're looking to scale to 150, 200 units. Now, we want to, a couple different ways. We're always underwriting the properties so we can individually exit. But what's more interesting is, could we roll these properties up to a REIT or IPO? Now, getting back to your question, though, in order to roll up to a REIT or IPO, especially an IPO, that business needs to have, we call it, monthly recurring revenue on it. Whenever you have somebody coming into a car wash that's paying individually, that doesn't work. So what is monthly recurring revenue? That's where you buy like a monthly membership, maybe it's $25, $30, $35. And you, as a member, get priority access to wash your car pretty much as many times as you would like. Now, the average consumer that has a monthly membership maybe will wash their car 2 times. So we have a very hefty delta in there on the margin. But because we have that monthly recurring revenue, now the business is valued much differently. And that is like part of the value add process whenever we're buying these kind of mom and pop facilities and rebranding them, putting on a heavy marketing strategy, changing up how the revenue is generated on the property. And then, like multifamily, like self-storage, creating operational efficiencies and adding additional streams of income. And that all kind of rolls up to the larger business plan, which impacts how we can actually exit that type of asset for our investors.
So on the car wash side, are you buying multiple car washes and putting them in like a fund? Are you so that you're kind of structuring, setting up to do a REIT long term or do a IPO on them long term?
Well, currently right now, we have the interest rate environment that we're trying to navigate, right? And I think this goes for anybody with any asset.
Yeah, for sure.
Rates, I would, I follow several economists. I don't play one on TV. I'm not one myself. However, a lot of that rate movement has already been priced in commercially into rates. Now, it doesn't say that they can't move, but, most commercial lenders I've spoken with personally on my portfolio, they were like, yeah, we priced that in March. Now, why do I mention that? Is because if you have an open fund, right, and say it's going to be open for a year, you don't have clarity on what that rate is going to be for maybe just for the properties you're acquiring early in the fund. You don't know what it's going to be for the properties later in the fund. Right. So what we're doing right now is that we're, grouping acquisitions by 3, 5, 7 properties at a time. And, you just, being able to contain that interest rate risk, pretty readily, because of that. The earlier properties aren't impacted by the later properties. Hopefully that makes sense.
Yeah, no, it does make sense. Interesting. So are you buying these all over the country or just in your local area? Or
we're okay. So that leads into the second part of why some people are like, I have never heard of this before. Like, I didn't know I could invest in express car washes. Well, if you think back 10, 12 years, probably like closer to 12, 14 years, self-storage. Okay, that industry wasn't consolidating yet. Why was that? There was no third-party management. What do REITs not want to do? They don't want to manage properties. They just want to buy a portfolio that's performing, that has third-party property management already in place, and they want to clip a coupon. That's all they want to do. Okay. Now, so for when we talk about express car washes, if we're going to be the leader in this industry, we also have to solve the third-party management piece. And that is what we're doing in order to make it an attractive investment for like a REIT or, to even IPO at the end.
So I don't want to get too far down this rabbit hole, but I do have another question about that.
Yeah.
So are you setting, when you look at management, right, there's two places. There's asset management and there's boots on the ground, the property management piece. So in a car wash, are not the people who are your managers on site, aren't they your boots on the ground? And are you just asset managing then? Is that how that is working? No,
we are building out the entire end-to-end property management company, if you will, for all the car washes. So, currently we have 86 employees that manage the car washes, and we're talking all the way from regional directors down to the actual employees on site. And so we are looking to make that asset, or excuse me, the car wash asset turnkey potentially for an investor in the future.
Wow, interesting. What a great concept. And, and I said earlier, boy, I always wanted to have a car wash, but, I never had played it out that way. So you really have kind of thought that through, which is pretty interesting. So let's talk about raising capital.
Okay, let's do it.
Obviously, in all the things that you're doing, there's a function of capital, right? So, and on both sides, you have private capital and you have institutional, and then there's, your debt portion. So, how are you raising, how do you go about raising private capital today?
Yeah, so I don't work with the institutional monies, but we largely are, in all of our assets to date, are largely retail capital. So that means just the, regular Joe accredited investor that, has monies to place in individual private placement projects. And so, for me, and my function as director of investor education, I am here to like actually help investors close the gap, like in a couple of different ways. Maybe they, are a high income earner and they're like, I don't have the time to figure out real estate, but it's attractive. Like I want to get it, diversified into it, or I want to actually I'm done with the volatile ride of the stock market, and please exit left off this train, right? Especially after yesterday, guys. So, anyways, or somebody, maybe even it's an investor that has built their own private portfolio themselves, controlled real estate, and in today's asset prices, they're going, how can I offset some of that gain and get it into a more passive investment where I'm not the one having to do the day-to-day operations or even being kind of the COO over property management. So I help investors kind of close that gap and understand what the investment is. Now, I have done the end-to-end capital raise myself, as well. And, really from there, what you're doing is, kind of more of a sales operations position with the investor.
Yeah, interesting. So you guys don't do any institutional capital. It's all private.
No, we are looking to attract institutional capital, but currently today it is been retail capital, a little bit of family office capital, but yeah, we are looking to bring, because we raised 189 million last year, and so we're looking to double that this year. So again, whenever you start thinking, bigger and bigger goals, you have to the same plan that got you to where you are today isn't necessarily the same actions that are going to get you to where you want to go tomorrow.
Did you say 189 million?
Yes.
Holy cow. That's a big number.
It is. We're super excited about it.
Yeah. How long have you been at this part of it, at raising capital? How many years?
So for me personally, I came from a different private equity firm, and 4 years is my experience in this space for raising private capital at this kind of larger institutional level.
So is there a process that works in here? And I don't think process is the right word, but like Saturday, just this past Saturday, I spoke at a financial literacy event where there was 50 people in the room, did a couple of sessions, and had a number of people say, boy, what I spoke on was the difference between active and passive investing, right? Yeah. So either you want to take care of the tenants' trash and toilets, or you don't, right? So, and that's what I talked about. And you'd be surprised at the number of people that show up and say, hey, I got a little bit of money sitting in a checking account. And one woman, a little bit of money to her was like $200,000. I was like, wow, so, I think that being in front of people, being networking, sharing with people what you do you find any systems or processes like that work better for you or well for you?
Well, so if you think about it, like statistically, there are a lot of accredited investors that are well versed about the multifamily space, and you don't necessarily have to have an accredited investor. It just depends on how you're raising your money. Right. Now you can either continue to go be at like real estate conferences, or where multifamily is being spoken about. Go to those type of meetups. Now, those investors are getting inundated. So then you have to start thinking about who is your ideal client that has the money to invest in my projects, and go to them. Maybe it's a medical conference or a dental conference or a chiropractic conference, right? We call it blue fishing in a way. Like, how can you find them and then bring them into your world? Now, the hard thing is, and it's something that, I've had to navigate personally, is, I can't just register for a dental conference and go. I'm not a dentist. Right. So I have to find a different way into that network, either, directly through somebody who has like a podcast or has a platform, or I have to get that person to vouch for me and saying, yeah, this is somebody you want to have at your conference. Please invite her in. So, those are the type of things I would think outside the box. Where is your ideal customer? And, how can you not let them come to your whatever you're raising capital for to find you, but how can you go to them?
Yeah. Yeah, that's interesting. You know, I had a friend when I was back selling real estate. I had a friend who he only focused on athletes. So he's in Manhattan Beach in California and started out with the Lakers. You know, and now he just, you know, he is like anybody that's moving to California or moving out of California that's on one of the sporting teams there, he really handles the business for them. He's really built an interesting platform around that. So this is kind I think that this becomes kind of the same thing, you know, when you're seeking high net worth individuals and that. So interesting conversation. How about debt? What are you finding about debt today?
Yeah. So as far as debt, we like private debt, for a variety of reasons. Especially like in the past year, you look at a lot of, operators that are in a GSC loan, like a Fannie Mae or Freddie Mac loan. They wish they could exit their projects, like in the past year and going into this year. However, what do they have on their loan? A prepayment penalty. So private lending might be a little bit more expensive. You might have a floating rate. There's ways to mitigate that risk, putting caps on it and extensions. But what you don't have is the constriction. You might have a short lockout period, like 6 to 12 months, right? But you don't have that big prepayment step down penalty, like 5, 4, 3, 2, 1, like over the course of 5 years. That might keep you trapped in a project or keep you and your investors trapped in a project. And so, but that's the type of debt that works for us. Certainly if the whole strategy is for like 5 or 10 years, GSC debt's great.
Yeah. For sure. Or bridge debt, fixed bridge debt anyhow, but it all, the price of capital is interesting today, right? I've been at this a long time. And to see where it was, where it went, and now where it's going again, it's kind of interesting. You alluded to the fact of what happened yesterday in the stock market, where, and I know you're not an economist. I always say that too. I'm not an economist, but I listen. And I think there's some really smart people out there to pay attention to. Where do you see the market going? Any thoughts or predictions?
I don't. And I'll tell you why. I broke up with the IRS and the stock market in 2017. My husband still has a little bit, in the stock market. He has the TSP, he's a government employee. I sleep really well at night. I have to keep tabs on it in order to talk to investors, that are really nervous, right? At this point in time, and, help them kind of like navigate the environment. I think the only comment that I would have, and again, I'm like you, not an economist. I don't even play one on television, but is, I think for a while, like the stocks have been overvalued, and we're seeing that pullback and correction on that. And especially post COVID, we had a lot of money go into the economy, but not the production to support it. And so there are certain pressures here that everybody's, reading the headlines, they're all doomsday, but this is kind of how markets have to correct themselves. So it'll be interesting. I have no crystal ball. For me, what I pay attention to are the fundamentals within my portfolio. Like, how am I investing in assets that have capital preservation, cash flow, that pull all three, equity, net operating income, equity levers, or, with car washes, expected gross income equity levers, to where the value can be controlled on it for appreciation, and then that have solid tax benefits. That way, if one of those principles kind of within the portfolio or with that asset kind of teeter a little bit, the other three can kind of make that up. So I can kind of work through any, economic environment and still make money.
Yeah, interesting. So, what are you working on right now?
So personally, or like with passiveinvesting.com?
Well, wherever you want to go. It's your rabbit hole right now. So
yeah, my rabbit hole. With passiveinvesting.com, we're still focused on, building out the car wash side of the business. That's really interesting. We have 14 assets. By the end of the month, it will be closed on that portfolio. We're looking to 10x that portfolio in the next couple of years. Year and a half to 2 years. Hotels, again, very undervalued space. We have our first project that's going to close at the end of the month. We've got another one right behind it that we're super excited about. So really just helping educate, investors understand how to create passive income, long-term wealth build with, hard assets that are backed by real estate.
Yeah, interesting. All right, well, let's do a little shift right now. I always like to ask a few bonus questions at the end just to get a little different perspective. So, what is the best book you've ever read?
Ooh, that is, I mean, there's a lot of books out there that are really great, like, fiction. I'm a huge sci-fi reader. However, the book that I read that I'm constantly going back and rereading is The One Thing by Gary Keller and Jay Papasan.
So there's two things now that you've said on this show that, I like, that we really resonate with me, which is resilience in that book. I was a Keller Williams agent for a long time, and two books I think Gary wrote with Jay is The Millionaire Real Estate Investor and The One Thing. I think they're both great books with a lot of timeless principles in them, that's for sure.
Absolutely.
How about favorite tourist attraction?
Favorite tourist attraction? We've been really going to a lot of like national parks lately. And I think that's, it's not just one thing right now, but really, just, hopping in the car, taking our 10-year-old and, normally we travel overseas like once or twice a year and do a little bit more like luxurious vacations, but we're really enjoying traveling more locally and just showing her the United States, but especially the national park system.
Wow, interesting. That's pretty cool. Anyone that really sticks out to you that you would point people to or go back to?
So, well, you can't go there right now, but Yellowstone, we've been there twice in the past 4 years, and just watching, my daughter just be wowed by the immense beauty and power of the area, but also the potential for intense destruction. And so that's, it's really raw, like, it's just very raw area. And of course we always love Jackson Hole with the Tetons, Grand Tetons. And that place has a special place in my heart. I went there as a kid several times during the year.
Yeah, I went to Jackson Hole and skied one time when I was in high school, and boy, never forget, it was beautiful. Why'd you say you can't go there right now?
Oh, it's the snow melt is running so high that they've had some bridges wiped out with flooding.
Oh.
Yes.
Missed a good skiing season, obviously.
Well, yeah, and also just that intense heat wave that we've been having out west. I mean, I know people people from Phoenix are like, cry me a river, right? Like it's 90 degrees, but whenever it's early June and we still have the snow-capped peaks, that's disaster for those towns in the lower lying areas.
It's 103 in Chicago this afternoon, so.
Oh, and the humidity. I'm sorry.
Oh yeah, it's like swimming, right? So, and last question: favorite restaurant?
Favorite restaurant? There is a restaurant here in Boulder called Frasca that is just an amazing like Italian restaurant. We just don't go there enough.
Yeah,
so.
I have one of those in Chicago. That's awesome. Good for you. So, Whitney, thanks for being on today. Appreciate it. It's been great to get to know you and explore a little bit more with you. So how do people get a hold of you if they want to connect and talk to you about car washes or hotels or multifamily?
Yeah, definitely. You can reach out to me at passiveinvestingwithwhitney.com. There's just a quick little form there so I can kind of like, get a quick snapshot of who you are as an investor. And then on the next screen, you get access to my schedule. And yeah, let's schedule a time to talk and see. I would love to get to know, people who are interested, get to know your investing goals and just if there's a way that I can help.
Yeah, interesting. Well, thanks for being here today. I appreciate it. I'm gonna move you to the green room if you hang out with me for a minute. I'm gonna say goodbye to everybody, and I'll be there in a minute. Hey, everybody, that was my interview with Whitney Elkins Hutton. Boy, what a great interview, talking about private capital and car washes and hotels and multifamily. So kind of a little bit of everything today, a lot of variety. So hey, I want to thank you for being here. Please make sure you tell somebody about this show. We're here every Saturday morning at 10 a.m. Central. Always have a guest on that we bring some flavor, some variety. Really, I always say raw and scripted conversation on Saturday morning, right? So grab your coffee and buckle up. Please go like us on anywhere you hang out on social media, whether it's LinkedIn or Instagram, TikTok, wherever. You'll find us with some relevant content every day, just bringing more value to you. So please go like us, follow us, subscribe to our YouTube channel. If you go there, there's tons of this kind of stuff out there. So enjoy yourself, and I look forward to seeing everybody next week. Remember the GOB conference, July 13th and 14th in Chicago. Use my last name as a coupon code, and you'll receive $100 off. Look forward to seeing everybody.